Many people believe that a share is just a number on a screen, a price that goes up and down randomly, something you buy low and sell high. But that belief hides what a share really is. In this video, we're going to understand a simple but powerful idea. What exactly is a share, and why its price keeps changing every day? When you understand this clearly, the stock market starts to feel less confusing and more structured. Let's begin from the basics. A share is not just a price, it is ownership. When you buy a share of a company, you are buying a small part of that business. Not physically, but economically. You become a partial owner. Imagine a company like a large Indian business. It has factories, employees, products, and customers. It earns profits. It also faces risks. When this company divides itself into smaller units and offers them to the public, those units are called shares. If a company has 1 lakh shares in total and you own 1,000 shares, you own a small percentage of that business. Your wealth becomes linked to how that business performs over time. This is the foundation of investing. You are not trading numbers. You are participating in business growth. But here is where confusion begins. If a share represents ownership, why does its price change every second? The business does not change every second. The answer lies in expectations. Share prices do not move only based on what a company is today. They move based on what people believe the company will become in the future. If investors expect higher profits, expansion, or stronger growth, they are willing to pay more for the same share. If expectations weaken, they are willing to pay less. So the price of a share is not just a reflection of reality, it is a reflection of collective expectations. Now let's connect this to demand and supply. Every time you see a share price, it is the result of buyers and sellers interacting. If more people want to buy a share than sell it, the price moves up. If more people want to sell than buy, the price moves down. This is basic demand and supply. But what drives that demand? Expectations, news, results, sentiment, and sometimes emotions. This is why prices can move even when nothing fundamental has changed immediately. Markets react not just to facts, but to how people interpret those facts. Let's take a simple example. Suppose a well-known Indian company announces plans to expand into a new sector. Investors believe this will increase future profits. Demand for the shares increases. The price rises. But later, if the expansion faces delays or higher costs, expectations change. Demand reduces. The price falls. The business may still be strong, but the expectations around it have shifted. This brings us to an important idea. Price and value are not always the same. Price is what you see on the screen. Value is what the business is actually worth over time. In the short term, price can move away from value. In the long term, they tend to come closer. Many investors lose money because they focus only on price. They chase rising prices. They panic when prices fall, but they do not take time to understand the underlying business. When you shift your focus from price to value, your thinking changes. You become less reactive and more patient. Another reason prices change is participation. The stock market is not just made of individual investors. There are mutual funds, insurance companies, foreign investors, traders, and even algorithms. All of them have different goals. Some invest for years, some trade for days, some react to global news, some follow strategies. This constant interaction creates movement. Prices adjust as new information enters the system. Volatility is not a flaw, it is a feature of the market. It reflects uncertainty in changing expectations. Now let's talk about risk. Every share carries uncertainty. A company can grow, it can also struggle. Competition can increase, costs can rise, economic conditions can change. When you buy a share, you are accepting this uncertainty. That is why returns are not guaranteed. This is also why discipline matters more than prediction. You cannot control the market, but you can control how much you invest, how you diversify, and how you react to price movement. Some people try to predict every price move, but the market does not reward constant prediction. It rewards consistency and risk control. Long-term investors focus on business quality, reasonable valuation, and patience. They accept that prices will fluctuate in the short term. Traders, on the other hand, focus on timing and momentum, but even they rely on discipline and risk management. What fails most often is not the idea of investing, it is the lack of a process. So what is a share, really? A share is ownership in a business. Its price changes because expectations change, and those expectations are influenced by information, sentiment, and human behavior. When you understand this, the market stops feeling random. It starts feeling like a system. A system that rewards patience. A system that tests discipline. A system that reflects both logic and emotion. Here is the key takeaway. Do not see shares as moving numbers. See them as parts of real businesses. And do not chase price movements without understanding what is driving them. Focus on managing risk. Focus on learning gradually. Focus on staying in the market long enough to benefit from compounding. Results in the stock market rarely come quickly, but with the right approach, they can come consistently over time. If you are here to understand the market step by step, calmly and realistically, you are in the right place. If this helped you, consider subscribing. I share educational video focused on clarity, discipline, and long-term thinking for retail investors.